What is going on, everybody? Welcome to another video. This is Q from Hyperstocks, and today we're going to break down the different indicators and oscillators that I use on my charts. I'm going to go through all of them except the MACD because that's one that I have on and off, and it's really anecdotal in which I use it. It's not something that I always have running. So first, I'm going to tell you guys what moving averages that I always have on. Those are going to be the relative strength index, so the RSI, which is here at the bottom. These are my settings for it at 14, 70, 30, and I have the Wilder setting on there. I also have volume constantly running. That is the most important indicator that I have on any of my charts. And then finally, I have moving averages, which I use for both day trading and swing trading. First, let's talk about the moving averages. I know moving averages can come in the simple moving average and then the EMA line, so the exponential moving average. The biggest difference between the two is that the EMA line runs a lot more tightly with the price action. So if you are day trading and you want your EMA, just because of the way it's calculated, it's going to run a little bit tightly and more quickly with the price action. So if you are day trading, it's going to smother it with movement. So it's not going to be as smooth as the SMA line would be. So personally, I like the simple moving average because I do focus a little bit more on swing trading and holding the position a little bit longer than a few minutes. Therefore, I prefer the simple moving average. But if you are trading within seconds, the exponential moving average is going to be a better choice for you. Now, in terms of the moving averages that I do use, I always have these running. So I have the 10 and the 20-day moving averages. Those are the two pink and blue lines. I have the 50-day moving average, the 100-day moving average, and the 200-day moving average. So if you don't understand what moving averages are, first let's go ahead and break them down. When we say 10-day moving average, all that means is that it's taking the price over the last 10 days and giving you the average movement on a dotted line. That being said, if a stock drops below its moving average of 10 days, that means it fell below the average price, inclining traders to potentially close positions or even open up positions if the stock is in an uptrend. So let's go ahead and look at a stock for an example. Here we have Zillow pulled up, but let's go ahead and take a look at an index instead. So when looking at an index like the S&P 500 or SPY in this case, we can see times in which the moving averages came in handy for many traders. So when the index was trading below the moving average back in March, it had a very tough time getting back above it. You can see how choppy these days were. It even dipped below the 50-day moving average, but it wasn't there for long before traders started adding to their positions. So when you have a strong, healthy chart that like the S&P 500, it doesn't really get stronger than the American market. That's in an uptrend and it dips below a 50-day moving average. A lot of times you'll see traders jump on it. That way they take advantage of the low pricing. If it hits the 100-day moving average, that's even a better price to get into. This only applies to stocks already in an uptrend, you guys. This doesn't apply to high risk short-term trades. That has an entirely different strategy. We're just teaching you the basics of moving averages here. Here's another time in which the moving average was used as support. So the 50-day moving average here was used as a support. The longer the time frame or the longer the moving average, so the 50 is going to be weaker than the 100. The 100 is going to be weaker than the 200. The reason why these are stronger as they go longer in time is because of that reinforced 200-day moving average. So we're taking the price over the last 200 days, not just the last 10 days when we look at the 200-day moving average. Now, when you're looking at a shorter term time frame or a shorter term picture, let's go ahead and pull up one of the stocks that we traded today. Here is the stock called MOSY. This may not be the best example. Let's go ahead and take a look at a stock like LEDS, in which was moving averages were used as a day trade. So the moving averages that most day traders are going to stick to are going to be the 10, 20, and the 50-day moving average. In this case, we can see that very early in the morning, LEDS had very strong volume that broke it above the 10 and the 20-day moving average. The stock moved up, but notice that when it strayed a little too far away from those moving averages, it needed to correct back down. This is when the RSI begins to become a very useful indicator. So apart from the moving averages, day traders are looking at the RSI. And here the RSI is trading above that 70-point mark. making traders believe that the stock is a bit oversold and it needs to cool down. So on the 1-minute charts, the stock was oversold. It's traded a little too far from the moving averages. We see this reversal candle at the top, therefore it pulled us back. You don't want to chase the stock on the way up. You want to catch it on a bounce. So in this case, the stock pulled back to the 10-day moving average, but it wasn't enough to alleviate the stretched out levels. Therefore, it came down to the 20 before I saw a buying candle, indicating that buyers did kick in at the 20-day moving average. Once again, we saw the stock ride that 20-day moving average up, came back down. It strayed a little too far away, couldn't hold support of the 20-day, and it used the 50-day moving average as support and pushed back up. So over and over again, you see this pattern happening. And volume is there to guide you along the way. So we're not going to focus too much on volume in this video. We're going to focus primarily on the moving averages. That way you can take full advantage of how to use them in your own trades. If you go up further, so a lot of traders will say, well, which one do I use? What time frame am I supposed to look at? Honestly, if you're a day trader, you want to focus on the time frame in which you are looking to trade the stock. So if you want to be in the stock for 1 to 15 minutes or 1 to 30 minutes, then focus on 1 to 30 minutes of time. Don't focus on a daily candle, but always keep it in mind because you really don't know. So for example, let me go ahead and show you an example of a stock that had a lot of potential on the intraday chart but couldn't make it because of the daily chart. But this is why you want to keep the daily moving averages and the daily candles in the back of your mind when you are trading, even on the short term. Because when this stock made its high through the day, many traders may have jumped in expecting it to continue to push on the initial morning rise because of all that volume that flowed in. But if you looked at the daily candles, you'll see that the stock was approaching that 100-day moving average, which is a very tough resistance to break. Therefore, it could not break out of it and it shot back down, which is why it's important to keep all moving averages in mind when you are trading. Now, moving into, say, an hourly chart, you can see that the stock is now trading above that 20-day moving average and just below that 10-day moving average. Therefore, it's using that 20-day as support, as you can see, as it has on that uptrend. When looking at a shorter term time frame, if you wanted to trade the stock on the 1-minute charts, you can automatically see that when in the morning time the stock dropped below the 10 and the 20, volume picked up. As soon as traders saw that drop below the 10 and the 20, it picked up selling volume, and more selling volume was accrued, and then therefore it sent the stock even further down. But in terms of moving averages, you guys, and indicators, that's kind of all that I had to say. This video did primarily focus on moving averages. Most other videos will have, a different explanations, but I thought this was a very good opportunity to take advantage of moving averages and how to use them for your trading.